This is Bible School Radio, KDKR, Decatur, Dallas, Fort Worth, KYJC, Commerce, and KMWC, Bethany. Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, rate and term refinancing, is it the right move for you? Today, stay tuned for Prudent Money. Good afternoon, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, today, from cash outs to refinancing, everything that you need to know, Mark Pfeiffer is here as he comes on once a month to give us some tips. He's going to talk a little bit about this. Hey, Mark, how's it going?
Mr. Bob, I'm doing great, my man. Thanks for having me as always.
Okay, let's start off with the brutal question first. How's rates?
I know, and you say brutal because you must know, but man, they've been not behaving the last couple of weeks, which is really unfortunate. So if you kind of look on most of the news mediums, like Mortgage News Daily, for example, will show that they're trending up in the high sixes now, which is, to put that in contrast, call it a month, I'm ballparking, but about a month ago, you were looking low to mid sixes. So not behaving. I don't truly understand all of what's going on outside of just the speculation is maybe the Fed's not going to be quite so generous with their cuts later this year. And the election, supposedly, that's an easy cop-out. They're saying maybe that's driving rates a little higher just with not knowing what the outlook will be here in the next coming week or two. So there you have it. Not great, but still not bad. I mean, better than the 8s we were looking at last year. So let's be optimistic, and we'll say they're still good, just not quite as good as we want them to be right now.
Yeah, I think that you got to, the listeners have got to appreciate how complex this is. I mean, you're also got to factor in really either presidential candidate who gets elected, they're going to spend a lot of money and they're going to drive up a lot of that debt. And that has potential effects on rates as well. So it'll be interesting for sure. But I do think, even though it's always easy to say the election, like you say, I do think that you're coming from two very opposite points of view when you look at the election. I think it will to reduce some of that not knowing the unknown. That's going to help a little bit.
Yeah, it's kind of like you don't know how bad something's going to be. If I'm going to tell you I'm going to punch you in the arm, you don't know how hard that's going to be. But once it's done and you know it while it hurts, you at least know what you're doing moving forward. So I think there is some of that. There's still going to be speculation of what happens, like you said, that if they spend money, it's inflationary. Does the Fed, taper or buy more quantitative easing, whatever the Fed's going to do. So there's certainly a lot to it. My prediction earlier this year was rates would end in the mid sixes. Initially a month ago I was wrong because they were in that low sixes, but now all of a sudden maybe I'm back to being right. Who knows? Well, time will tell.
Well, let's talk a little bit about cash outs. What is a normal cash out, and maybe some other types of cash outs? This is something I can't believe we've never talked about this.
Well, I think we've talked about it. I just don't know if we've dedicated the whole time an episode to it. But the reality is Texas, so for, I would assume the majority of the folks listening here within earshot, if you're in Texas, we are unlike any other state in all of the union. So we are one of 50 that have these different cash out laws. So in Texas, and cash out can mean various things for different purposes. But in general, in Texas, they're known as what's called an A6. And that's because the Texas Constitution, and yes, there is such a thing. I learned that when I got in the mortgage business 20 plus years ago. The Texas Constitution basically addresses how home equity loans, cash out loans, have to be addressed in Texas for a primary homestead. So a cash out is when somebody's tapping into their equity, whether they get money back to be determined. We'll probably talk about that. But it's when somebody's going to access their cash for some purpose. It becomes a home equity loan. And there are instances where cash outs does result in people getting money. And there's instances where cash out loans result in people doing other things with their money, like home improvements or paying off debt or things of that nature.
So, one thing that came to my mind was this really depends a lot on the value of the house. Have you seen how have you seen the values of homes from this particular context? Have they stayed pretty stable? Are they come down quite a little bit, or what have you seen?
Yeah, so the good news, again, North Texas has been great. We've had this conversation, multiple times about just how we're so diverse in terms of just geographically we're centered in the middle of the country. We got a ton of different types of economy. In Houston back in the day used to be like Midland. They're oil based. Houston's more diversified now. So just geographic, economic, demographic, all these different reasons, North Texas has been great. And so for the most part, I would say values have held pretty well. There may be small pockets where you've seen maybe a little dip, but just think back 5 years ago. I mean, that's what COVID has done for us here in North Texas is our property values have just skyrocketed. And while we can shake our fist and say, man, that stinks for affordability, it's true for somebody buying a home, but for those homeowners, I mean, if you own a home in the last 5 years or even the last 2 or 3, you've done well from an equity position. So to answer your question, we've not seen a ton of issues yet. Time will tell, but I don't foresee any real major issues in the near future. But because Texas still is growing and North Texas, there's still a lot of folks coming here. So values have been increasing. And right now, as a country, we have the most equity we've ever had in our housing just because of the recent boom we've had in the last 3 to 5 years. So equity is at an all-time high right now, and that's why we have been and expect to see a lot of cash outs coming our way.
So it would seem to me that there's a window of opportunity here for sure that people need to be, if they're thinking about it, need to really look into it.
I would always say, here's the reality is making the phone call and having the conversation and running the numbers, there's no cost, right? The cost is going to be your time, and certainly there's something to it, and it's not the most fun conversation, and to take time out of your day and call somebody and spend that time to do it. But the reality is, to your point, Bobby, this is a great time to at least explore the options, because in the same breath, while equity is at an all-time high, unfortunately, credit card debt, consumer debt is at an all-time high. So this is a great opportunity where somebody can tap into that equity, maybe push reset. I know somebody we just helped, they were able to take out all debt in life now except for the mortgage. They tapped into that equity. They're paying it off, and they're saving tons of money from paying off that bad debt, and now they can start just kind of push reset and start saving and putting money where it needs to go.
Let's talk a little bit about the difference between saving money and lowering your monthly payment.
Yes. So this is the hot button for me. I'm very passionate about this piece. There is a very big difference. Your monthly payments, right, like what your obligation is to the mortgage company, that you have the ability to refinance, have that monthly payment obligation go down, so lower, that's a good thing, but still not save money. And it does. Now, the way that makes sense or doesn't make sense is that folks that got a mortgage 5 years ago and they refinance, they could, in theory, go back to another 30-year note, and all of a sudden, while they're saving and I'm making up a number here, $200, $300 a month, they could be paying more interest or the same amount of interest they were initially paying, but the cash flow feels better because they reset the clock on that loan payment. Now, if their objective is to create some cash flow, because maybe that just helps pay bills, maybe their income's not as high as it once was, I'm not saying that's a bad thing, but absolutely, every homeowner needs to know there is a difference between saving money in terms of interest paid and saving cash flow in terms of what's owed each month. And that's where you do need somebody to help come in and just run the numbers with you to make sure you at least know what you're doing. Both can be okay options. I'm not saying you shouldn't do it. I'm just saying know what you're doing and why you're doing it.
Yeah, that's interesting that you bring that up, because you're absolutely right. You think you're doing something good, but in fact, you're not really doing something that lines up with what your purpose of doing it in the first place.
And so what I would recommend is if somebody is going to explore that option, I don't want to speak for every mortgage company because I don't know that every one of them can do this, but I do know a lot of mortgage companies in that scenario I just gave, if the true objective of somebody is to save money, save interest, right? So let's say they're comfortable with their monthly payment now, that extra $200-$300 in this example doesn't mean much. They could refinance and I'm going to pick a number, they could do a 23-year mortgage So instead of putting their 5 years in, instead of resetting the clock to go back to a 30-year note, maybe they do a 23-year mortgage to where their payment stays the same. And so you would think, well, how are they saving money if the monthly payment's the same? Well, the difference is they just cut off 2 years or maybe 3 or however many. They just cut off many years of paying interest, and now more of their payment goes towards principal than it does interest. So there's a way to shorten the term so that while it's not cash flow feel good, maybe the same amount, they'll actually save money by paying the loan off quicker.
Now, is this what you mean by a rate and term refinance mortgage, or is that something different?
Well played, my man. You've done your homework. Yes, a rate and term means you're changing one of those things. You're either changing your rate or you're changing your term or both. You're not getting cash out. A rate and term refinance means that you're doing something. You're changing the rate or the term or both, but you're not necessarily getting money in your pocket in the form of a cash out.
Yeah, I can imagine that's a painful conversation to have.
It's interesting, and the hard part, and this is the frustrating part too. Having done this for over 2 decades, I know it's like numbers are what we do, right? We're good at it. We see these, we do these every day of our working lives, and I understand that having this conversation with the homeowner, it's like something they do once every, I'm making this up, but 5, 7, 10 years, right? It's not a normal everyday thing. And so it can be frustrating because this is complicated, where if we can't get across the messaging, the savings, because it can be confusing, it gets frustrating to know that financially this is the right move, but they're paralyzed. And some of that, because I take it a little personally, like, man, they don't trust us that we're doing the right thing for them, or we're just not being clear and we're not showing them in a, making the complex simple. It can be very frustrating. It can be complicated. And that goes back to what we've always said on this show, and we say it probably every time we get together, which is work with somebody you know and trust and like, right, to know that they have your best interest, because these can be a lot of moving parts. And it's easy, unfortunately, it's easy to be led astray for somebody that's just got commission breath and wants to close a loan to get paid, because that's not the right way to do it, and that's not always the right way to do business. Never the right way to do business. So yeah, it's tough. It certainly is.
Yeah, and I'll bet you're seeing a lot of that happen right now.
I won't name names, but just like I said, work with somebody you know, like, and trust, because there are companies with reputations, and unfortunately, a lot of times the bigger they are, the less sophisticated and the less professional some of the folks on the other side of the phone may be. So and I don't think they do it with ill intent. I don't think most of them do anyway. I just think they don't know any better, and they haven't spent 20 years doing this. So that's my part to say, work with somebody you trust, and get someone like yourself, right? A third-party financial person that can help just discern and strip away some of the fluff and make sure you're doing the right thing for you and your family.
Yeah, I would think for the normal average person, when you put the numbers in front of them and you go, look, Mr. Smith, you're going to save $300 a month. That's pretty significant. And it's, where do I sign up for that? But you don't see the dark side of that equation.
Well, the other part too, and again, I don't want to get too far in the weeds, but just to show how complicated it can be. And I know we have talked about this before. There's different ways to structure it where you can roll in cost or pay the cost, or quote, no cost loans. So all those structures can also get in the way and become very confusing. And then this time of year, right, it's October, here in North Texas, property taxes are about to come due if they haven't already. So that then adds another element. If there's an escrow account or somebody who's like, I don't want to pay my taxes, but if you're refinancing today, if the tax bill is due, that's got to come into the equation. So there are a ton of moving parts, and I mean, there's no loan, you can have the same loan program, same rate, and same this, but the reality is there's always going to be different, unique circumstances for families. So while the two loans may be the same, they may not be the same loan for the reasons they want. So it really is important just to make sure that you're talking to somebody that understands your needs, your desires, your wants, and can help structure the loan the right way.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Mark Pfeiffer's with me today. If you want more information about Mark, go to mortgagemark.com. Let's talk about what are some of the good reasons for someone to consider refinancing their mortgage.
There's a lot. So just kind of off the top of my head, obviously the rate and terms we've been talking a little bit about, maybe you can improve your financial position, save some money, taking cash out, like whether it's to pay off debt, consolidate credit cards, or pay for college tuition that may be coming up. Maybe it's for home improvements. Maybe because now that housing's gotten more expensive, it may be hard to find that maybe it's hard to find that next level up in house. Well, if you spent the money on your current one, maybe it just gives it that new facelift you love. So home improvements, putting in the pool. Sometimes there's circumstances where life happens, whether it's divorce. We do see that on occasion where it's like you got to pay your soon-to-be ex-spouse, so you got to get them out of the equity position. So there's a variety of needs and wants and reasons. We have some folks that just want more cash. They want access to the money. They may not need it, but they want access to it because they're starting a new business. Or there's this litany of reasons. So I would just tell folks anytime that you think you need cash, I would absolutely at least have a conversation with a mortgage person just to know options. I'm not saying it's the right way all the time, every time, but it's good to know your options, to talk with a mortgage person, to talk with a personal banker, and just make sure you know what it is you have in front of you. So whether it's a cash out or just trying to save some money, those are really the two big drivers for why somebody might come in and have that conversation.
So let's talk a little bit about costs. Obviously, any of these transactions are not free, even though some make it look that way. But talk about some of the costs to go along with refinancing your mortgage.
Yeah. So just to be clear, there is a difference between no cost and no cost out of pocket, right, or free, right? Those are all different things. Like free, you'd imply it's free, right? There's nothing in life that's free. There are costs that are regulated by the state, like title policies and things like that. So generically speaking, it's kind of hard to say, because this loan versus that loan. But if you just told me, hey, there's a $400,000 loan, they got the loan 2-3 years ago, it wouldn't surprise me if there's about $4,000 worth of cost, $5,000. I'm sure compliance-wise, they don't want me saying that, but let's just go with that kind of as a round number. If you see $17,000 as just to put it in contrast, if somebody says, hey, it's going to cost you $17,000 to do this, I would either just be dubious and look at the fees. And again, we're happy to help if somebody's already too far in or committed to somebody else. We're happy to always look. But a lot of times, Bob, like I said, some of those may not be quote unquote cost. It may just be your property taxes that are due, or they're setting up a new escrow account, but they didn't have one before. So it's hard to say how much it truly can cost, but I would absolutely say nothing's free. Let's make sure that's very clear. Nothing in life that I know at least has been truly free. And I would say it's really important to separate the difference between cost and then prepaid, your taxes and insurance and things of that nature, because that's just the cost of home ownership. So it can be really tough, but that again goes back to work with somebody you know, like, and trust.
So, Mark, let's talk a little bit about the current interest rates today. What a minefield to have to navigate through. What are some of the things that you want to consider, that some tough decisions you might have to make with given the rate structures of what's out there today?
Man, that's a great question. And I know we're coming up on time, so I'm going to answer it as succinctly as I can, but that's probably that's the part that's the hardest thing to answer, because now we're asking to look into the future, right? What's the crystal ball say? Because there's no guarantee rates come down. I think they can and will in the next 12 to 24 months. So what we've been advising, and I'll speak for just myself in this sense, my opinion, is if a refinance would make sense today and you figure out the true cost. So let's talk rate and term. Because a need-based refinance, like cash outs, you need the money to go do something, that's going to have a different conversation. But if you're truly just saying, do I refi or not because of where rates are, if you can make your money back in the next 12 months, I'd say do it, because that's a really quick payback period. If the costs are going to be such that you don't get your money back for 3 or 4 years, I might say let's wait and see what's on the other side of this election. Let's wait and see what early next year brings with more rate cuts. I would say if it's going to take too long, let's not pull the trigger and spend that money. But if you can get your money back pretty quick and justify it within 6 to 12 months, that's where I'd say it makes sense, and let's pull that trigger. Otherwise, let's just put you on just get a plan in place and then start watching rates.
Credit scores are a big deal. How does that influence someone's ability to refinance?
Look, higher is always better. It doesn't mean you have to have it. A lot of things come into play. If somebody's got a bunch of equity, if they're doing a 15-year loan versus a 30-year, credit won't impact you quite as much. Certainly, I would just say this: before you try to do anything yourself, talk to a mortgage professional. Go ahead and pull your credit. It's okay; it won't hurt you. Not the same way that most people think. And then get a plan in place. But don't just go doing stuff trying to be good and proactive without having a mortgage person consult with you and create a plan. Because again, people try good intentions don't always work out to be good results.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Talking to Mark Pfeiffer, and if you want more information on Mark, go to mortgagemark.com. How do you go about, as we kind of wrap things up here, how do you go about calculating a break-even point to make sure that refinancing is financially worthwhile?
Yep, hard to do it for the home. It's hard to do for those playing at home, right? Because you need to know two things. You need to know what the true costs are going to be to do the loan, and that's where a mortgage person can help you out, right? To say here's what the cost would be, and then you compare your current loan versus the proposed new loan. And you compare those two things to see how much interest you would save. And I take it typically over 3 or 5 years and take that average and say, okay, if I'm going to save on average, let's just make up a number. If on average you're going to save $2,000 per year in interest and mortgage insurance and whatever, over the next 5 years you're going to save $2,000 a year, and the costs are $4,000. You then know it takes 2 years to make back that $4,000 you're about to pay in fees. So that's a simple way. Again, it's hard to do at home by yourself, but that's why I work with a mortgage professional so that you can do that formula and determine if it really is worth it or not worth it to you.
Okay, and we got about a minute left. So I meant to ask this question at the beginning of the program. With rates doing what they are doing right now, what kind of effect has that had on just transactions on real estate and buyers and sellers? And it seems like that they're just kind of frozen, maybe not knowing what to do.
They have been. What's funny is that I just saw a headline right when we were doing this. It says it says mortgage applications aren't crashing. They're just being logical. So I think a lot of folks, to your point, not just with rates. Like we got some clients that were, I would say, trusted us, and when rates went down to low 6 for that very short window, we got a lot of folks that listened to us, rightfully so, and we locked and we got it. The ones that didn't, we're now waiting. So to answer your question, yeah, the market is very much wait and see. Again, we got 2 weeks from now, we'll have a little bit more certainty, and then obviously the next 8 weeks for the rest of the year, we'll have more certainty with the Fed. So it's a weird market, Mr. Bob, but I would say it's never too early to start having conversations and getting a plan in place.
Once again, Mark's website is mortgagemark.com. Mark, always good to talk to you. Appreciate you coming on.
You're the best, my man. I appreciate you.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. You know what's interesting is that as being in the business of watching money and watching rates and markets and all that kind of thing, the question comes, what would really have to happen to bring interest rates down, to make them fall down? I don't think down to where they used to be, but just maybe into the 5% range or so. I think would do it. That would kind of get things going again. And it makes you wonder if it's going to take a kind of a nasty recession to happen. But if that happened, does that necessarily mean that mortgage activity would pick back up, even though rates are falling? So it's a complicated subject, and for sure. Hey, this is Bob Brooks. You got a question for me? Please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.